In this video, I'm going to highlight the importance of keeping losses small. I'll make you a promise that if you pay careful attention to this lesson and commit yourself to the discipline required to follow what I'm saying, that you'll do better than 90% of investors who risk their money in the market. I'll start off with a simple question. If you were able to go back in time and eliminate just 2 or 3 of your biggest losses in trading, how much further ahead would you be right now? I know for me in my trading, I would be happy to eliminate just one of my biggest losses. I've read countless interviews with top traders, and while their methods are very different, they all have one common practice, and that is they cut their losses short and keep them small. When these same high-performance traders are asked what separates successful traders from unsuccessful traders, and they overwhelmingly answer that it's the failure to cut losses and keep them small that keeps people from being unsuccessful. And there's a good reason for that. It's because cutting losses is one of the most difficult things to do in trading. Here I'm going to highlight a setup that Setwit took back in July of 2010 in Rubicon, ticker symbol RBCN. Now the stock had a nice looking base, and it broke through on high volume through the yellow buy zone, which is where we entered the stock. The very next day there wasn't much action going on, and the day after that there was even more follow-through day, up on very high volume. I think we were up about 6% in this position at this point, 3 days in. So far so good, right? Well, the very next day, wham, the stock gets hit for like 10% down. No news, no earnings, nothing that I could see that would cause such a huge spike down. But here we are, going from 6% up to 5% down in one day. So at this point you have to make some decisions. Do you hold to the stock and hope for a turnaround? Or do you cut the loss and move the capital into a better situation? Most people after this kind of event are a little shell-shocked. They start rationalizing and making excuses for why they need to hang on to the stock. However, no matter how good the company is or how much potential some analyst says the company has, the fact remains that the position is down 5%, and that's all that should really matter. As we always preach at Setwit, potential doesn't always equal performance. We always have a sell plan for every stock we buy because we know that there is no guarantee in the stock market, no matter how good a setup looks or how great a company's fundamentals are. In the case of Rubicon, we bumped our sell stop up to the lows of this sell-off day, and we were sold out of the position the very next day. Now, I won't bore you with the play-by-play of the next month, so I'll let the chart do the talking for me. Here it is a little over a month from where we exited for a loss of 5%, and the stock is down over 35% from its highs. Could the stock have recovered from where we sold it? Yes, but in the stock market, our returns are based not on what could happen, but what's happening right now. Sometimes stocks do bounce back and recover after we sell them, and that's just a part of trading. However, all it takes is one stock that you own to go down 30, 50, 70% or more, and you'll be in a position where it's very difficult to recover from that loss. A 5% loss, that's very easy to recover from. However, if we were to hold on to this stock and be down 35%, that's a loss that's going to be very difficult to recover from. So it's very important to keep your losses small and manageable, and this will ensure that you never find yourself having to recover from a devastating loss. Losses are a part of trading. No matter how good your system is, they're always going to be there, and they're always unpleasant. But by keeping them small and manageable, you will always be able to recover quickly from your losses and move on to the next trade.